How much weight would you put on that number yesterday? That's got to be the first question this morning.
Well, it's not just that number. It's not just the ISM manufacturing. If you look at spending data that came out on Friday, it was weak. You look at the GDP revision last week, it was negative. So there has been a trend, right? So if you look at kind of the U.S. economic surprise indicator, it's taken a turn for a softer direction. So I would think that it's not entirely surprising that growth is cooling off from the elevated levels that we have seen. We always thought that the Fed wants to cut, and maybe this makes the case for them starting the rate cut this year.
Some people might make the argument then, weaker data, lower rates, let's buy bonds. Is this the moment to buy bonds?
Well, we still like equities better than bonds.
Why is that?
Because earnings are strong. U.S. earnings have just delivered the strongest growth in over 2 years, and margins are expanding in 7 out of the 11 sectors that we look at. So ultimately, we're seeing a bit of a, I wouldn't call it a big disconnect, but growth is cooling, but companies are able to continue to grow in the context of mega forces with AI benefiting the profit cycle. And as a result of that, equities are still well positioned, especially in the context of rate cuts coming. So yesterday we saw a bit of a bad news, somewhat good for risk sentiment.